Welcome back to Market on Close. I'm Marley Caden. We have just a few minutes left in the trading day, so it's time for the big picture. We'll welcome in our team from Charles Schwab. Joining us today, Collin Martin, the Director of Fixed Income Strategist at Schwab Center for Financial Research. Collin, thanks for being with us today. An interesting start to the week for us with some weakness. What are your thoughts?
Well, yeah, we see Treasury yields up and Treasury prices down a little bit. So I guess you could describe that as weakness. But I think the move up as the day progressed likely is the result of the increase in tariff rates right now. If those do come to fruition, I think there's an idea that the Fed certainly holds that it should be somewhat inflationary. And I say somewhat because we don't know exactly how those tariffs will flow through to the end consumer, but we think there should be some sort of impact because there's really three things that can happen. The exporter can cut prices, the importer can absorb the tariffs, or they can pass them along. Given the magnitude of the tariffs and that they've been in place for a little while now, we think we'll start to see some of that flow into consumer prices. So I think that's weighing on the Treasury market right now because inflation was and has been trending in the right direction for the past handful of months. If we see that stall out a little bit or maybe even pick up because of tariffs, that can keep the Fed on hold for a little longer than initially expected.
So first thing I have a couple questions, follow-ups for that. But the first one I want to JP Morgan put out a report earlier today saying that they see stagflation now as a serious risk to the Goldilocks narrative that we've, been seeing that's sort of driven us to these highs in the markets. Do you think that that's, a concern that's warranted with all of the tariff uncertainty?
I'd say it's a concern, but we're not there yet. But when I hear the risk of stagflation, I think it's important to put some context around that because as it stands right now, growth generally remains positive. We got a pretty bad first quarter GDP print, but a lot of that had to do with imports and exports and not really underlying demand. And if you dig deeper, underlying demand is still there. So we still think we're seeing positive growth, although we do expect it to slow as the year goes on. But that's important because when you talk about the stag part of stagflation, if we're still seeing a positive reading, that's important. On the inflation front, yes, it's above target, but we're still generally seeing inflation rates on a year-over-year basis, say in the 2.5% to just under 3% area. That's a far cry from levels we saw in the 70s and 80s and the past relationships when people tend to worry about stagflation. So yes, it's possible we see slower growth and higher inflation, but I think the magnitude of the numbers matters where I don't think it's going to be as bad as a lot of people are worrying about.
And with the Fed, my second follow-up to your original answer, with the Fed in its wait-and-see mode that we're watching, waiting to see how much tariff impact there's going to be, what the end result of these tariffs are going to be, B of A put out a base case today that they're maintaining 0 rate cuts this year, which sort of goes against the majority. Do you think there's a possibility that we see no rate cuts this year?
I'd say never. There's a possibility. I'd say there's not a high likelihood of that right now. But we think over time, if we do get our outlook for slightly slower growth, we think that over time would likely lead to some more cracks in the labor market and maybe an uptick in the unemployment rate. So even if we do see inflation kind of hold where it is or even pick up a little bit because of potential tariff pass-through, it's possible we see an uptick in the inflation or the unemployment rate. And that could result in the Fed cutting a little bit. If that doesn't happen, and if we continue to see, solid growth and a labor market that's holding steady, then the Fed might not need to do anything. I think what's really interesting is how resilient the labor market has been right now. If we look at the unemployment rate, I know it's just one indicator, but if we just look at that unemployment rate, it's held between 4% and 4.2% for 14 straight months. That's remarkably resilient. If that holds for a while, the Fed might not need to do anything. So it's not our outlook. I think if the unemployment rate stays low, that gives the Fed more time to remain patient and push back the timing of that rate cut. But we do think we'll probably see some weakness as the year progresses.
And Collin, in your outlook, when do you think we might see that first cut? In the fall?
Probably in the fall. We're sticking with our September or later guidance. I know that's kind of a cop-out. We're basically saying July is really not on the table. That's pretty clear right now after Friday's jobs report. The implied probability of a cut in July is, I think, 5% or less. It could happen in September, but even those odds have come down lately because of that labor market report. It is really going to be data dependent. The Fed has this outlook that tariffs should be inflationary. They are worried about that. But if they don't start to see it in the data, and we do see that disinflationary trend come down, I think that would allow the Fed to cut rates. But for now, they're not in a rush. I think that's really the key thing to point out right now, considering that the consumer remains, somewhat strong, although we're seeing spending come down a little bit. The labor market's stable. The Fed doesn't really need to tinker too much. Not that they want to wait for things to suddenly get really bad before they start to act. But right now, the indicators they see don't suggest that they need to be acting too quickly.
And I want to talk about this weekend's news, the big, beautiful bill getting passed on the July 4th holiday. How is that, if at all, going to affect yields?
There's a few things in the bill that we think could have affected the bond market. One thing I'll focus on first is the impact of budget concerns and what that might mean for the Treasury market, because there's a number of estimates about where the deficit and debt levels could be over the next decade or so. But a number of studies suggest it could increase the debt and deficits by 3 to 3.5 trillion over the next 10 years. That could keep long-term yields elevated even in the face of Fed rate cuts. Historically, though, we haven't found much of a relationship between budget deficits and debt levels and what that means for Treasury yields. We get asked this question a lot. If our debt continues to grow, what does that mean for long-term Treasury yields? We don't have a relationship to point to suggest that an increase in X in the deficit results in an increase in Y for Treasury yields. But we do think is that as long as debts continue to grow, and those concerns about our fiscal trajectory weigh on the market, that could keep long-term yields elevated. And we might need to keep yields kind of where they are to attract that marginal buyer. So that's our main guidance for our clients right now. Even though we expect those rate cuts to come at some point, we might see the 10-year Treasury yield kind of hang out in that 4.25% to 4.5% range because of those long-term budget concerns.
So you don't necessarily see them rising much further. You think they'll sort of stay within this 4.25% to 4.5% range?
That's right. And there's a lot of concern when people, I think, get worried about the impact of our fiscal trajectory and what it means for long-term Treasury yields. I think a lot of investors worry that we'll see an increase, in percentage points. The 10-year Treasury yield rising to, 5, 6, 7% or more. That's not really our concern. We think more in basis points. So yes, there could be some upside. Maybe it even does rise to 5%. That's not really our outlook right now. But we think any rise would be relatively modest, and it's more about keeping a potential floor underneath long-term yields.
Well, Collin, thank you so much. As always, again, that's Collin Martin from the Schwab Center for Financial Research.